The Federal Reserve left interest rates unchanged on Wednesday, despite 3 officials voting for an increase. That's the headline from the New York Times, and it signals a split at the central bank as inflation remains above target. The Fed voted 9-3 to hold the benchmark rate steady at 3.5 to 3.75%, a range that has been in place since January. The decision comes after 5 years of inflation running above the Fed's 2% goal, and pressure has been building for a more aggressive response. Kevin M. Warsh, the Fed's new chairman, vowed to fight persistent inflation but stopped short of specifying whether that would mean raising rates. The 3 dissenters wanted a hike now, arguing that waiting risks letting inflation become more entrenched. The majority, however, opted for patience, likely wanting to see more data on whether price pressures are easing on their own. Markets had priced in a high chance of a rate increase, so the hold came as something of a surprise. Stocks initially rallied on the news, while bond yields dipped. Analysts say the split vote underscores the uncertainty facing policymakers: move too fast and you risk choking off growth, move too slow and inflation expectations could unmoor. Warsh's first meeting as chair was closely watched for clues about his leadership style. His statement emphasized data dependence and a willingness to act, but the lack of concrete guidance left many questions unanswered. The next policy meeting is in 6 weeks, and between now and then, a slew of inflation and employment reports will shape the debate. For now, the Fed has bought itself time, but the dissent shows the consensus is fraying. That's the story. Thanks for listening.